So you want to own an airline. Fill every seat, collect the fares, watch the profits roll in. Sounds simple enough. It almost never is. Here's the part almost nobody understands about this business. An airline does not always want a full plane. Sometimes an empty seat is worth more than a seat sold too cheap. Most people think an airline sells transportation. It doesn't, not really. What it actually sells is a seat at exactly the right price, to exactly the right passenger, at exactly the right moment. This single idea explains almost everything strange about airline economics. You will see the costs, the pricing trick, and the airline that forgot all of it and shut down for good. This is not really a story about planes. It is a story about what happens when a business forgets to protect its own margin. Stay with me, because the ending happened just this year. The bill that never stops coming. Now the plane is flying, and the real bleeding begins. Fuel is the single largest and most unpredictable cost an airline carries. It can eat 20 to 30% of total operating expenses in a single year. A sudden spike in oil prices can wipe out an entire quarter's profit overnight. Crew payroll is next, and it does not shrink when a flight is half empty. Pilots, flight attendants, and ground staff all get paid on schedule regardless. Maintenance is constant, and it is never optional. A single engine overhaul can cost more than most people's houses. Regulators require inspections on a strict schedule, whether the plane flew full or empty that week. Insurance, airport fees, and technology systems add another steady drain every month. The bill arrives whether the plane is full or nearly empty. The billion-dollar entry fee. Let's start with what it costs just to get a plane in the air. A single new narrow-body jet can run over $100 million. Most airlines lease instead of buy, but the monthly payments are still enormous. A single leased aircraft can cost several $100,000 a month before it ever takes off. Add pilot training, certification, and safety compliance before a single ticket sells. Add gate leases at major airports, which can cost millions per year each. Add the takeoff and landing slots themselves, which are sometimes bought and sold like real estate. At a busy hub, a single valuable slot pair could be worth tens of millions on its own. None of this generates $1 of revenue yet. It is simply the cost of being allowed to compete. Why an empty seat can be a good thing. Here's the part that sounds backwards until you think it through. A seat sold 6 months early for $50 is locked in forever. That same seat, held empty until the week of departure, works differently. It might sell for $400 to a business traveler with no other option. Airlines build entire systems just to make this bet correctly. It is called yield management. Prices shift dozens of times before a single flight departs. Some seats are deliberately protected and kept empty on purpose. The airline is betting that a late, high-paying passenger is worth more than an early, cheap one. A single flight can carry a dozen different fare classes for the exact same physical seat. The passenger in seat 14C might have paid 3 times more than the one right beside them. At the same time, airlines overbook flights to cover passengers who never show up at all. Historical no-show data tells the airline almost exactly how many extra seats to sell. Get the math wrong, and the airline has to pay bump passengers to give up their seats. Get it right, and every seat that would have flown empty turns into revenue instead. The margin between those two outcomes can decide whether a route is profitable at all. Both strategies are chasing the exact same goal. Fill the plane with the right revenue, not just any revenue. An empty seat is not always a failure. Sometimes it is a seat still waiting for its best possible price. The trap of selling too cheap, too early. Here's the trap hiding underneath this entire business. An airline that sells too many seats too cheap, too early, loses its safety margin. There is no room left to protect for late, high-paying travelers. Worse, there is no room to absorb a sudden shock, like a fuel price spike. Costs can jump overnight. Ticket prices already sold cannot be raised after the fact. An airline trapped in rock-bottom pricing has nowhere left to go when the bill comes due. Raising fares overnight risks losing the exact customers the airline built itself around. The entire business becomes a bet that nothing unexpected ever happens. The airline that ran out of runway. Meet Spirit Airlines. For over 3 decades, it built its entire identity on the lowest possible fare. Extra charges for bags, seats, and snacks kept the base price famously low. Passengers grumbled about the fees but kept booking anyway, chasing the cheapest fare on the board. For years, that model drove real growth and attracted price-sensitive travelers by the millions. Competitors copied the exact same playbook soon after. The advantage stopped being an advantage once everyone else could offer it too. Spirit filed for bankruptcy in November 2024, restructured, and emerged the following spring. The new plan leaned on a bet that fuel prices would stay low and stable. Planners assumed jet fuel would average around $2.24 a gallon. That bet failed badly. Jet fuel prices surged well beyond what the restructuring plan had assumed. Spirit filed for bankruptcy again in August 2025. Analysts pointed to a simple, damning number. Revenue per seat had fallen behind nearly every competitor in the industry. The airline had spent years mastering how to fill a plane. It had never mastered how to fill a plane at a price that could survive a bad year. A federal bailout worth $500 million was floated as a last resort. The airline's own bondholders rejected the proposed deal. There was no other rescue plan waiting behind it. On May 2nd, 2026, Spirit shut down completely, grounding well over 100 aircraft. More than 17,000 people lost their jobs that day, while over 100 aircraft sat grounded overnight, suddenly worth nothing to their owner. It was the first major American airline collapse in 25 years. Rival carriers moved almost immediately to absorb the route Spirit left behind. The real odds of owning one. In the optimistic scenario, an airline protects its highest value seats carefully. It fills the rest efficiently, and margins stay positive even when fuel prices climb. In the realistic scenario, an owner chases growth by selling every seat as cheap as possible. There is no cushion left when costs rise and no room to raise prices fast enough. Spirit spent over 3 decades proving exactly how that story ends. Every airline on Earth is running the same math in the background, seat by seat, mile by mile. The ones that survive are not the ones that fill every seat. They are the ones that know which seats are worth leaving empty.